The market maker's spread is the house edge of a digital casino, and the math is heavily rigged against you. While ordinary traders stare at basic charts and candle patterns, institutional market makers look directly at the order book to exploit micro-level inefficiencies.
Headlines about flash crashes, botched IPOs, dark pool investigations, and a famous author has dominated the perception about equity market structure. So today we have 5 esteemed panelists who are going to talk beyond the headlines and provide you some insight on the current market structure issues.
High-frequency algorithms weaponize these hidden structural gaps every single day, quietly pulling capital away from unsuspecting retail accounts. To survive in this environment, you have to realize that bid-ask spreads are not fixed metrics. They are highly fluid, manipulated battlegrounds.
When we're talking about trading, the activity of trading, what we're really talking about is participation in an auction. Another way to put it is we're participating in a negotiation. And this auction is not a single-player game. It's a multiplayer game. And if you understand what those different players...
If you don't understand that these order books are constantly flooded with fake liquidity, you are stepping directly into a trap. A fatal error most market participants make is focusing purely on price action while entirely ignoring the order queue.
Stock quote, you will typically see a stock's current price, volume, and the bid and ask prices. Often investors attempt to buy or sell a stock focusing solely on the stock's current price. They place an order at the stock's current price and become confused why their buy or sell order is not executing. This is primarily due to the investor not paying attention to the bid and ask prices.
Placing a simple limit order and expecting a fair execution is exactly what predatory algorithms look for to freeze your capital. Spoofing operates much like a coordinated cyber attack, where massive phantom orders are flashed to artificially alter the spread before being deleted.
Of the spammer or some hacker or some bad person has noticed it, and let's say they are trying to send email to my customers using my domain. Yes, they can do it if you do not set up this SPF on your domain. I hope you get idea, guys, about this SPF framework or sender policy framework.
By creating a massive illusion of buying or selling pressure, these firms force retail traders into executing at the worst possible prices. Institutional researchers classify this phenomenon as structural liquidity risk, where brief order imbalances are manufactured to trigger panic.
Understanding where our financial risks are the greatest and what regulatory response should be made to these risks. So we estimate this measure, and I'll tell you a little bit about it, but not actually too much about actually how we do the estimation, based on market data on equities and accounting data on financial institutions.
These systems calculate the precise boundaries of market depth, knowing exactly how much slippage retail traders will tolerate. The primary objective of the algorithm is entirely predictable. It hunts down heavy clusters of stop-loss orders visible on their heat maps.
Algorithms. They're written by a programmer, and they have to be written to go somewhere, okay? Where are they written to go? These technical areas that we're having this conversation. There's no...
By flashing massive ghost order blocks, they force price action to drift directly into liquidity pools that feed the market maker. While common logic suggests that institutions need major directional trends to profit, sideways consolidation is actually their ideal environment.
Making money when ITC goes up to, let's say, 310 rupees, 320 rupees or 340 rupees. You will book the profit and you will feel very happy that, hey, I have made the profits. But have you thought about the fact that when the markets are moving sideways, so they are not going up, they are not going down, they are moving sideways, or when the markets are going down, is there a way for you to make money? The answer is yes.
By keeping the spread pinned within a tight horizontal range, they rapidly harvest option premium decay, while retail capital sits paralyzed. Decades of high-frequency tick data confirm that these micromanipulations are systemic, highly repetitive, and completely intentional footprint patterns.
And this next panel is going to be about using archives. And now that we have these two archives, how are people putting them to use? Whether they're going online and listening to an oral history, or they're coming into the library and actually engaging with materials. What are they finding? What kinds of projects are they using our materials to support?
Examining these granular high-frequency logs exposes the precise moments where natural price discovery is warped for corporate gain. The public's perception of value usually relies on lagging financial metrics, but market makers operate on a lightning-fast structural plane.
Take the opposite side. No, because this consensus can be right, and often is. But what it means is that when you come up with an idea and it is contrary to the consensus, and you think it's got a good chance of happening, and it's a trend that's working, then that's where you want to really jump on it with all force. That's what we did in the early 2000s.
The algorithm uses temporary fake spreads to disrupt price stability, forcing retail participants to execute panicked, emotional errors. To protect your portfolio, you must completely refrain your understanding of the book and ignore superficial liquidity signals.
Just kind of seeing things a little bit differently. I'm actually saying wake up and see yourself from another perspective. Start seeing things, the world, in a whole different way. And once you do this, it's going to completely change your dynamic of your trading. But I will give you a little forewarning. If you do wake up and if you do start seeing things completely different.
Once you stop chasing short-term spread fluctuations, the structural traps become glaringly obvious, completely shifting your trading edge. It is easy to feel completely secure when utilizing hyper-detailed retail charting platforms, but the entire game is configured to quietly drain you.
I think one of the hidden things to do is you really are a function of who you're surrounded by. Invest in your network. And I don't mean that in a kind of cold-hearted, I want to network with these people, but just surround yourself by people who are also trying to push themselves, to push their income.
Trading based on standard technical indicators while neglecting algorithmic microstructure is a guaranteed recipe for systematic losses. Retail traders globally study the exact same textbooks and use identical breakout lines, a predictable blueprint market makers exploit daily.
In my 10 years in stock markets, I have read several books, seen several interviews, talked to several analysts and stockbrokers, and I know the common mistakes traders and investors make in stock markets which don't end well. What I'm going to share with you today is not something which I've read from a book.
Knowing exactly where retail stop orders are bunched up allows high-frequency firms to trigger efficient, targeted stop hunts. When a retail participant tries to trade a major key level, they treat visible volume as a sign of security.
This is something that drives me up the wall, and it's not out of a frustration at the retail crowd. Let me be clear. I think it's a frustration at the fact that nobody has said anything better or different, not consistently at least. A lot of people believe that good trading comes down to picking a level, finding a setup, getting an entry with a tight stop loss, shooting for massive reward to risk ratios, and being right more often.
This constant slippage isn't an accident. Market makers are intentionally spoofing orders to clear out your position. Guarding your capital requires specialized analytical models that isolate non-bona fide orders and instantly filter out fake liquidity.
System that these three servers are your server. That means you are sending email to your customer only by using these three servers. But if anyone sent any email by using your domain outside of this three server, let's say by using this server 4, then by setting up SPF, the email sender can automatically detect that this is not you.
Advanced tracking scripts serve as a layer of defense, identifying whether massive block sizes represent real institutional interest or phantom lines. When market volatility spikes violently, true liquidity frequently vanishes, leaving behind a highly toxic and empty order environment.
Much capital these institutions do hold, and when we have a financial crisis, this leads to a decline in equity values for the global market as a whole, as well as for each of these financial institutions. And so if their equity goes down, we estimate how much we think the equity of this institution is going to collapse.
Algorithmic systems instantly sense these severe structural thresholds, pulling their bids and letting retail traders absorb massive slippage. At its foundation, the bid is the absolute maximum a buyer will pay, while the ask is the absolute minimum a seller accepts.
And ask price, with the bid being the highest price buyers are willing to pay for a stock, and the ask being the lowest price sellers are willing to sell a stock. These two prices are determined from the buy and sell orders submitted by investors from all over the world. When someone wants to buy a stock, they will receive the stock at the ask price, since this is the lowest price sellers are willing to give it up for.
When market makers deliberately stretch this spread wider, they force the public into bad entries, capturing immediate, riskless arbitrage. High-frequency systems operate at speeds that completely bypass human perception, sweeping through critical zones to trigger automatic margins.
I started focusing on the algorithms a very long time ago. It wasn't my will, I was an agent. Algorithms are there to create volatility and liquidity. They want to trap. One of the trades that lose money 85-90% of the time is when you sell a failed breakdown. Those algorithms know that. You just know it. And I know that those algorithms are going to make that print.
By manipulating spread depth at precise technical price points, they force cascading liquidations and extract risk-free gains. Average market participants are structurally disadvantaged, routing their flow through retail brokers that sell that exact data to market makers.
Strategies to secure reimbursement for medicines from healthcare payers and ensure patients have access to medicines. And payers in some geographies are private payers and insurance companies. Other cases, it's government organizations or governments directly. And if that's the one sentence explanation, I think about market access as really having 3 steps.
This plumbing is entirely intentional, ensuring retail order streams are isolated and cleanly picked apart behind closed doors. In the modern era of automated trading, the pure density of order book updates has skyrocketed, drowning human manual analysis completely.
The reality of what has happened 30 years later is we don't work less. We just write much longer Word documents. And our PowerPoint decks have gone from 6 slides to 50 slides. And I say that as a consultant. Also, we engage in much more complex decision-making because the amount of data that we have to process has just exploded.
To weaponize this information overload, institutions employ predictive neural networks to constantly morph spreads and paint fake order patterns. Hidden underneath the visible lit exchanges are private dark pools, where institutions cross massive institutional block orders entirely out of sight.
And we have 37 active ATSs, equity ATSs, 35 of which are dark and 2 are semi-dark, and we'll get to what semi-dark means. We have 9 retail wholesalers, 3 single dealer platforms, 3+ single dealer platforms.
By masking their actual block size while actively spoofing public exchange books, they lock in an unassailable structural edge. Think of the market maker's spread as the ultimate mathematical house edge. No matter your temporary wins, the math ensures the house collects.
Which is the house edge, okay? That's the spread, that's the brokerage. If you look at the scoreboard down at the bottom of the roulette wheel, you know the electronic scoreboard?
Yeah.
If you look, you're going to see long runs of red, long runs of black, okay? And it should be red and black, red and black, red and black, but life is not like that. You get clusters of good luck and clusters of bad luck.
By constantly fine-tuning the structural advantage with ghost liquidity, they guarantee long-term profitable distribution for their firms. If you want to break out of this cycle, you must look past the patterns on your screen and study the mechanical architecture of execution.
Are running their advertisements during even Indian Premier League, right? So seeing these advertisements, lot of people come into the world of stock market, but say if 100 people come, out of that only maybe 10 or 20 or even 30 people may be actually ready to learn about the markets. And these people who are ready to learn, if they learn well, they can win in the market. The other people who just want to get rich from the market, I'm not sure about them.
Only a tiny fraction of market participants actually take the time to dissect order routing and institutional infrastructure. By filtering out phantom book liquidity and tracking only authentic volume footprints, you can protect your capital and trade like an insider.